Hi guys, how you doing today? In this episode, we're going to talk about a topic that comes up quite a bit in my practice, and that is pricing. And what do I mean by that? Well, usually small business to mid-sized business owners don't truly understand what their break-even is. When I first started consulting, I was actually quite surprised that so many business owners, even though they're making money or sometimes not making money, they truly don't understand what their true cost is. And they mask that misunderstanding by using some markup, some factor that they take. They take their labor and their material cost and they add it together and they multiply by some number which has been used by their father and grandmother for the past 100 years. That's how we've always done it, is what I've heard many times. But I mean, that's not how you price something. You have to understand your market, but you also have to understand what your costs are, and that way you won't get in trouble. So the cost of something, whether it's a product or service, is composed of two different things. Number one are cost of goods, so labor, material, payroll taxes related to the labor, workers' comp related to the labor, payroll costs when I say that, and FICA, FUTA, SUTA, which I'm sure you're all familiar with, and any benefits associated with the work being done out in the field or work being done out in the shop, that kind of thing. So those are your cost of goods sold or direct costs, and they will increase based on your sales, usually proportionally. Quite frankly, they do move proportionally. So out of every dollar, you're going to figure out, if you print off your income statement or your P&L, your profit and loss, you're going to see your sales at the top, and then the next group of information below the sales is going to be your cost of goods or your cost of sales. So divide your cost of goods divided by your sales, and that's your percentage. So out of every dollar, whatever that percentage is, that's how much money that you can't use for anything in your business. You immediately are paying it out. So that's our direct cost. But then we've got our overhead cost, which gets forgotten quite a bit. And when I say it's forgotten, it's not truly understood well. Yeah, we'll understand. Okay, yeah, we've got all this overhead costs, such as power, paying for the power, paying for the heat, paying for the income taxes, paying for the phones, payroll taxes related to office staff, owner salaries, that kind of thing. Those are all overhead items. So an easy way to understand the difference between overhead and your cost of goods is overhead is something that's going to be paid if you sell something or not. So if you have absolutely no sales, you've got all these costs that you got to pay, and that's the easiest way to understand the difference between overhead and cost of goods. Okay, so now that we've understood that, how do we price? So the easiest way to do this is, you know what your cost of goods is. A lot of times business owners truly do understand that. They'll know what their labor is, what the cost of materials is, and they'll add those together, and whatever shipping costs for any materials to bring it into their workplace. Okay, so now that's your cost of goods. Now, how do you add overhead? Well, as I mentioned, the easiest way to do that is take from your last year's P&L, take your income statement or your profit and loss, same thing. Get that from your accounting system and take your total overhead costs, which are down near the bottom, and divide them by your cost of goods sold. That will give you a percentage. And what you're going to do then is, when you have your cost of goods on a particular item that you're selling or a service that you're offering, you're going to multiply that by your overhead factor. So again, overhead factor is on your at least 1 year's worth of income statement. You're going to take your total expenses or overhead and divide that by your cost of goods, and that'll give you a percentage. So let's say it's 25%. And you know that something that you're producing is $100, as an example. So your material and labor is $100 for something. And then your overhead factor is 25%. So you're going to take your $100, you're going to multiply that by 25%. So you're going to take your 100 plus 25% of 100, which is 25. Your total cost then is $125, not 100, because now you've added that overhead using that overhead factor. So that total cost then that we just figured out with our cost of goods and our overhead is our break even. In other words, we can't sell it for lower than that price. Otherwise, we'll be losing money, and we don't want to lose money. Can you sometimes sell something for break even? Yeah, you might need to keep your crew busy. You might need to because you have inventory that's been sitting for too long. You just want to move it. So you, bottom line, cut it down to bare bones minimum, which is your break even. And I mean, really, you don't want to go lower than that, otherwise you will lose money. And then you'll hopefully sell what you have to sell. But typically, we use that break even to understand. Okay, that's our cost. So now we want to add whatever profit that our market will pay for, that we understand our market. So that's the easiest way to understand pricing of goods and services, and it applies for any good or service. If you apply this method, it'll work for any for any product or service, and you will never get hurt. You will truly always understand your pricing, and you'll understand your profit margins as well. That's the end of this episode, and if you like what you heard, feel free to comment below, and please hit the subscribe button. We'll talk to you soon, and there'll be many more of these videos to come. Have a great day.